Welcome back to the deep dive. Today, we're jumping into a question lots of investors are asking. Should you go for an ETF tracking the NASDAQ 100 or one tracking the S&P 500, especially, in today's economy? Okay, let's unpack this because these are two heavyweights, really popular benchmarks in the U.S. stock market, right? Both give you way into large, successful American companies. But picking between them, it can feel a bit overwhelming. Our goal today is to sort of cut through that complexity. We'll lay out the key differences and hopefully help you figure out which one might actually fit your goals and, importantly, your tolerance for risk.
Exactly. And, while they're both popular, both focused on large cap stocks, and yeah, they even share some top holdings, they are pretty different fundamentally. We're talking differences in like the sheer number of companies they track, how those companies are weighted in the index, and crucially, the sector allocation. And these differences, they've led to really quite varied performance over the years. So understanding how they're built, that's absolutely essential if you're thinking about investing in an ETF that follows one of them. What's inside really matters.
Right. Getting that foundation is key. So let's start with the S&P 500. People often call it the broad barometer of the U.S. economy.
Right.
What actually makes it that comprehensive indicator?
Yeah, good question. So the S&P 500 has been around since 1957. It's not just like a random list of 500 big U.S. companies. It's specifically designed to be this broad, capital-weighted indicator. It pulls companies from both the NYSE and the NASDAQ exchanges. And these 500 companies together, they represent something like over 80% of the total market value listed on U.S. exchanges. So yeah, it really is a broad snapshot.
Now, 80%, wow.
Yeah, it's significant. And the weighting, it's based on market cap.
Yeah.
So the bigger the company's market value, the bigger its slice of the index pie. But what's also really important here is the diversification. It's built to spread across, I think it's over 11 sectors now. The goal is making sure no single sector gets, too dominant. For example, tech is around 27, maybe 28%. Healthcare is about 13%. Consumer discretionary, maybe 12-ish.
Yeah.
So the total tech part is kept under 30%. And you'll see why that's a big contrast in a minute.
Okay, under 30% for tech. Got it.
And just to give you a feel for it, top holdings include giants like Apple, maybe 5.9%, Microsoft 5.6%. But you also get more traditional names like Berkshire Hathaway, JP Morgan Chase, both around, say, 1.3%. It really shows that widespread across different types of businesses.
Yeah.
Okay, so the S&P 500 is clearly about that wide net. Diversification, stability, representing the broad U.S. economy. A real cornerstone. Now, let's pivot to the NASDAQ 100. This one often gets talked about with words like innovation, growth. Here's where it gets really interesting. If the S&P is the whole orchestra, maybe the NASDAQ 100 is more like the lead guitar solo. Can you break down its unique features for us?
I like that analogy.
Mm-hmm.
Yeah, the NASDAQ 100, it came along a bit later in 1985, and it tracks the 100 largest non-financial companies listed on the NASDAQ exchange. That non-financial bit, that's absolutely key. It changes everything.
So no big banks or insurance companies.
Exactly. By leaving those out, the index becomes heavily weighted towards global tech giants. Apple, Google, or Alphabet rather, Microsoft, Amazon, Tesla.
Yeah.
These dominate. So you get this intense sector concentration. Technology companies alone make up, over half the index. Some sources say almost 58%. If you look at popular ETF like QQQ, it could be even higher, maybe closer to 64%. Other sectors like consumer services are there, maybe 19%, consumer goods around 9%, but they're much smaller pieces.
Over half in tech. That's a huge difference from the S&P's sub 30%. How does that concentration show up in the individual stock weights?
It shows up very clearly. If you look at the top holdings again, Apple might be over 11% in the NASDAQ 100. Microsoft may be over 10%, Amazon around 7 or 8%. Compare that to their single-digit weights in the S&P 500. It just shows NASDAQ 100 is, a lot more concentrated in its top bets. That's why people often just call it a tech index or maybe a thematic index. It's really a focused bet on those high-growth, often innovative companies.
So we've got the broad S&P 500 versus the focused, tech-heavy NASDAQ 100. It sounds like one might be steadier and the other potentially faster, maybe? How has that actually played out in terms of performance over the years?
Yeah, that's a million-dollar question, isn't it?
Yeah.
Historically, this is pretty striking. The NASDAQ 100 has significantly outperformed the S&P 500 over the last 15 years or so. And we're not talking small amounts. The NASDAQ 100 delivered a compounded annual growth rate, sort of its average yearly return of around 16%, the S&P 500. More like 8%. over that same stretch.
16 versus 8% annually. That's huge over 15 years.
It really adds up. And if you look at a specific period, say end of 2007 through to early 2024, the NASDAQ 100's total return was up like 929%. That's more than double the S&P 500's total return in that time. It actually beat the S&P 500 in 12 out of those 16 calendar years. The average annual return was over 18%. Yeah. And 2023 was a massive year for it, up about 55%, mostly because of that big tech weighting and the excitement around AI, the drivers. It really comes back to that heavy concentration in high-growth tech. And companies involved in artificial intelligence, think about the FA stocks, Facebook, Meta, Apple, Amazon, Netflix, Google, Alphabet. They make up a much bigger chunk of the NASDAQ 100. 30%, versus only about 14% in the S&P 500. So their amazing run over the last 5-10 years really pulled the NASDAQ 100 up significantly.
Okay, those returns are seriously compelling and makes you think, why wouldn't you just go all in on the NASDAQ 100? But there's always a but, isn't there? What about the risk side? Volatility, especially in today's economy, things feel a bit uncertain. So what does this all mean when things get rocky?
That's exactly the right question to ask. That potential for higher reward comes with higher risk. The NASDAQ 100 is generally seen as more volatile. Its concentration in tech means it can be prone to bigger swings, especially bigger losses during market downturns. We saw this historically, like back in the dot-com bust in 2002, the NASDAQ 100 fell around 38%. The S&P 500 drop was closer to 23%, or the 2008 crisis, the NASDAQ 100 dropped about 42%, while the S&P 500 was down around 38%. Still bad, but less severe.
Okay, so bigger drawdowns are possible.
Yes. And more recently, think about 2022, when interest rates started climbing rapidly. That hit growth stocks hard, and the NASDAQ 100 definitely felt that more than the broader S&P 500. The thinking is if the tech sector hits turbulence, which, it does sometimes, the NASDAQ 100 is likely to feel it more intensely. Plus, there's an argument that some of those big tech names, the FAANGs, have already had such a massive run-up. Maybe it's harder to sustain that pace, and if there's a correction, they could get hit harder.
Right. So more potential upside, but also more potential downside risk. But you mentioned something earlier about volatility maybe not being that much higher.
Yeah, this is actually a really interesting point from the research. Despite the bigger potential drawdowns and crises, if you look at the average day-to-day or year-to-year choppiness, there are rolling volatility over 16 years. The NASDAQ 100 was only about 2.7% more volatile than the S&P 500 on average. And maybe even more surprising, their daily movements are highly correlated, like 93% correlated.
93%. So they generally move in the same direction day to day.
Pretty much, yeah. It suggests that while the NASDAQ 100 might amplify the market's moves, both up and down, it's not usually going off in a completely opposite direction. It kind of challenges the idea that it's a totally separate beast. But still, that S&P 500, with its broad spread across sectors, is generally considered the safer bet for downside protection. It tends to smooth out the ride a bit more. Although there's a flip side. Remember that no financials rule for the NASDAQ 100. Sometimes that helps. Like after the Silicon Valley Bank issues, the NASDAQ 100 was somewhat insulated from the banking sector's drop because it doesn't hold those stocks.
That's a good point. So the exclusion can sometimes be a benefit. Okay, this paints a much more nuanced picture of risk and reward. Now, practically speaking, you don't buy the index directly. You buy an ETF. What should listeners think about when choosing an actual ETF, and how do you, decide which path S&P 500 or NASDAQ 100 is the right fit?
Right, ETFs are the way to go. It's usually the easiest and cheapest way to track these indices. For the NASDAQ 100, the big one is Invesco QQQ, often just called the Qs. For the S&P 500, you've got very popular options like iShares IVV or Vanguard's VOO. One practical thing to look at is the expense ratio, basically what the fund charges you each year. NASDAQ 100 ETFs like QQQ tend to be a bit more expensive, maybe around 0.2% per year. S&P 500 ETFs like VOO can be incredibly cheap, like 0.03%. It sounds small, but over decades, that difference adds up.
0.2 versus 0.03. Yeah, that can compound.
Definitely. Another thing is dividends. Those high-growth companies dominating the NASDAQ 100, they often reinvest their profits back into the business rather than paying out big dividends. The S&P 500, because it includes more mature, established companies across various sectors, tends to have more components that pay regular dividends. So that's a different source of potential return for investors.
Okay. Costs and dividends, also important factors. So this raises an important question. Bringing it all together, who is the S&P 500 ETF really for, and who should consider the NASDAQ 100?
Good way to frame it. So the S&P 500 is likely a better fit if you're looking for a really diversified portfolio. If you want that broad exposure to the U.S. market, maybe lower volatility overall, and steady, balanced growth long term. It's often seen as like a core holding for people who prioritize stability and want a mix of both value and growth companies. Sort of a smoother ride, generally speaking.
Okay, the steady bedrock.
Exactly. Now, the NASDAQ 100, that's probably better suited for someone who is comfortable taking on a bit more risk in exchange for potentially higher returns. Someone whose main focus is on, say, technology innovation and who is really aiming for that high growth potential. You have to be okay with the bigger swings, though.
Higher growth focus, higher risk tolerance.
Precisely. Ultimately, the choice really boils down to your own personal risk tolerance, your financial goals, your time horizon. And it's not always an either choice. Some investors actually decide to hold both. They might use the S&P 500 as their core holding for stability and diversification, and then add a smaller position in the NASDAQ 100 to try and capture some of that extra growth from the tech sector, sort of getting the best of both worlds, potentially.
That's a great point, mixing them. Okay, we've really dug deep today. We've looked at the core differences, the historical performance, the risks, the practical stuff like ETFs and costs. It's clear both the S&P 500 and the NASDAQ 100 have been, fantastic ways to invest in the U.S. market over the long haul. The better one, it really isn't a simple answer, is it? It truly depends on you, the investor.
Absolutely. And maybe if we connect this to the bigger picture, a final thought for you to consider after this deep dive. As technology just keeps reshaping everything and the global economy keeps shifting, ask yourself, how much weight do you want to put on broad market stability versus that concentrated bet on innovation when you're planning out your own financial future?
That's a really powerful question to end on. Food for thought indeed. Well, thank you for joining us on this deep dive. If you found this chat helpful, maybe share it with friends or family who might be wondering about the same things. And of course, make sure you follow the deep dive on your podcast app so you don't miss our next exploration.